What if paying off your house was actually hurting your retirement plans? The American dream has always been to what? Buy a house, and then as we near retirement, we're told that a paid off home equals financial freedom. But the reality, the wealthy people, they almost never rush to pay off their mortgage. There's a reason. And if you're over 50 and you're serious about protecting your money and building retirement, you can actually enjoy this one strategy you can't afford to ignore. So let's talk about this. Why a paid off home can actually backfire for you in retirement. So most of us, we grew up believing the goal was to own our own home free and clear. That's actually one of the Dave Ramsey baby steps. Once you get to the end, you pay off your house. Then you're free, right? But here's what wealthy people know that most people don't. Money that's actually tied up in a fully paid off home isn't doing anything for you. It's what I call dead money. How is it dead money? Well, it doesn't, if it's dead, it doesn't do anything. It's not alive. It's not earning income. It's not growing. And it can't be used to create more wealth. Why? Because it's just sitting in your home. Picture this. You put, let's say you have a $400,000 house, okay? You put $400,000 year after year after year, and you finally put that into paying off your house. Now, that money is actually locked inside what? Your four walls. But if that same $400,000 was invested into some sort of income producing asset like real estate, dividend paying investments, buying a small business, anything like that, that money can actually pay you every single month and keep compounding over time. That's why the wealthy don't race to pay off their house. They understand that leverage creates options, and options are what build true financial freedom. Then we get into this, and you've probably heard this debate before. We have good versus bad debt. Whether you realize it or not, in my opinion, not all debt is bad. The wealthy make a very clear distinction between bad debt and good debt. What's the difference? Well, bad debt is tied to things that actually go down or lose value. Credit cards, car loans, personal loans, that sort of thing. Good debt is different. It's low interest debt used to buy things that go up in value, appreciating or income producing assets, what we just talked about. A fixed rate mortgage is considered good debt, especially in today's environment. Why? Because while inflation actually pushes prices up higher and higher, the dollar over time loses buying power. Your mortgage payment that you got 25 years ago, it stays the same, unless, of course, you refinance. So if your interest rate is, let's say, 4%, and inflation is 4%, you're essentially borrowing money for free. The wealthy know how to take care of that gap. Number 3, and now that I'm over 50, I can definitely appreciate this. Cash flow is king, especially when you're over 50. Or if you're younger and you want to retire earlier. Because once you hit 50, a lot of times people, they shift to more of a play it safe mindset. They think peace of mind comes from being debt free. But true peace of mind comes from having options. That's why I talk about getting to the point that work is optional. You have options. Do you want to go to work or not? You have an option. It's up to you. Okay. So this true peace of mind, it comes from having options, and options come from cash flow. Paying off your mortgage early, it drains your liquidity. It traps your money. Keeping that mortgage and investing that cash instead gives you other streams of income. It gives you emergency reserves and flexibility. That's the kind of security the wealthy build into their retirement plan. Number 4, this is what the wealthy do instead. Okay. So instead of them paying off their mortgage, or this is how they approach their mortgage, okay? So they take a 30-year mortgage, they take out a 30-year mortgage. What have we been told? Take out a 15-year mortgage, pay that house off faster, right? So they take out a 30-year mortgage, not a 15, so they can keep payments lower and invest the difference. They keep cash available for business opportunities and market deals. They use equity wisely through cash out refinances or HELOCs to put money to work instead of, again, letting it sit around doing nothing. They understand inflation. So they let inflation do the heavy lifting. So they're literally paying back tomorrow's debt with today's cheaper dollars. And they focus on this. They focus on return of equity. A paid off home gives you what's your return? Zero return. Leveraged properly, they can earn conservatively 5 to a little bit riskier, 12% a year instead of 0%. Why don't people do more of this, what we're talking about? It's because of this. It's the 4-letter word that starts with an F, maybe not the one that you think about. Fear factor. Most of us, myself included, were raised to believe that all debt is bad and a paid off house equals safety. If you grew up like me, listening to people like Dave Ramsey and Susie Orman, all debt is bad, paid off house equals safety. Probably for most people, that's probably a good idea. But if you want to grow your wealth and get to the point that work is optional, this is what I'm recommending. And I get a paid off house. I understand it feels good. But when was the last time you paid your bills with your feelings? Pay with cash. Cash flow pays your bills, right? So wealthy people, they don't let fear drive their decisions. They use math, they use numbers, they use strategy and long-term thinking. That's how they build wealth that lasts. Now, there's always exceptions, okay? So when actually does it make sense to pay off your house, okay? If you think about it, if your rate is high, if it's 7-8% or more, and you really don't have a better place to invest it, then yeah, I would say go ahead and pay that house off. If you're already financially free and the emotional payoff outweighs the numbers, do it. You know yourself better than anybody. You know yourself better than me. So if that's you and you just cannot sleep at night, pay off that house. And if you want to just cruise into retirement and just simplify it, and cash flow really isn't a concern to you, pay off that house. Okay. But here's the thing. Even then, the wealthy people, they weigh the opportunity cost. So they're thinking, or they're asking themselves, what else could this money be doing for me? Instead of, if this money wasn't sitting here in this house, what else could it be doing for me? Unless the answer is really nothing better, then they don't rush and pay off their house. So let's talk about the retirement opportunity cost. So imagine that you're 52 years old, all right? So you're 52 years old and you've got around $150,000 left on your mortgage. And let's say your mortgage is 3.5. You come into $150,000. Okay. Let's say maybe somebody left it to you inheritance. Maybe it was a big bonus. Maybe you were transferring jobs, assigning bonus, whatever it is. Okay. You get a check for $150,000. You're like, okay, I'm going to pay off this house. But instead you invest that money at, let's just say, a modest 7%. Over 20 years, because again, you're 52, so at 72, you're investing it, and it grows to a little over $420,000 while you are continuing to pay off your mortgage with cheap debt. And at the end of the day, 20 years, you still own your house free and clear, and you've built close to $500,000 in additional assets. Again, that's how the wealthy use leverage to win the retirement game. Now, there's new rules for retirement after 50. The old rules say what? Pay off your house, cut expenses, play it safe, live in fear mode. The new rules, keep your cash flowing, invest wisely, and use leverage strategically. I'm not talking about being reckless with this. Use it strategically and focus on freedom, not fear. When you're over 40, your strategy really matters more than ever. It's different when you're in the 30s because you got plenty of time. But as you get closer to retirement, you really got to start thinking about the things that you're taking that really going to matter moving you to the next decade, because you don't have decades to recover from mistakes that you had in your 20s. But you do have time to build something great if you play offense Don't just play defense the whole time. You play offense the right way. So again, I don't want you to confuse debt-free with financially free, which some of these people out there lead us to believe. The rich don't lock their wealth inside four walls. They put their money to work to buy back the most important thing there is out there. And as you get older, you're going to realize this. It's time. They work to buy back their time. They're creating options, and they build true freedom. So if you want to think and retire like the wealthy, do yourself a favor. Consider what you're doing. And if you're rushing out there to pay off your house, maybe reconsider it. Let your money breathe. Let it grow and let it create the retirement you actually want.